1031 exchanges don't work like they used to in today's high interest rate environment. In today's video, I'm gonna go over the number one mistake I'm seeing investors make in today's market. They're getting so focused on saving tax dollars that they are neglecting their investment returns. They are leaving money on the table by not making the best move. Now look, I'm not saying 1031s aren't a powerful tool. They absolutely are. They're an amazing vehicle to defer capital gains, but it's not the only way. When you go out there and see these real estate mega millionaires and billionaires, do you think the only thing they're doing is 1031 exchanges? Absolutely not. They use them, but it's only one tool in their toolbox. So I'm considering doing something I never would have imagined even just a couple of years ago. And that's selling my $1 million fourplex, not doing a 1031 exchange, and potentially looking at a six-figure tax bill. Why? Well, I've seen so many super successful real estate investors focus on these two core principles. And the last few years, I've been focusing on myself, where I've paid almost nothing in taxes while getting double-digit returns in my real estate portfolio. So I'll discuss those concepts and go through three options that aren't 1031 exchanges that you can do in 2024. My name is Chris Lopez, and I'm an investor here in Denver, Colorado. Now, I have really focused my investing and my business on helping investors optimize their real estate portfolio, figuring out what moves they can make to optimize their returns to meet their goals. Now, quite a few of my clients have said, Chris, you're basically my real estate financial planner. You help me figure out what I need to do with my portfolio. And that puts a smile on my face and is a huge compliment. But look, I am not your financial planner. I am not your CPA. So make sure you talk to your team and figure out what's best for your portfolio. This video is brought to you by Property Llama. Property Llama is software that helps you analyze your rental portfolio and maximize your return on equity. You see, I built countless spreadsheets, which was great for me and my clients, but it quickly became a nightmare to manage all those files. And that is exactly why we built Property Llama. I needed a better way. My clients needed a better way to go out there and understand how to evaluate their rental properties. So go to propertyllama.com/BiggerPockets, create a free account, upload your properties, and get a free analysis on how your portfolio is performing. Plus, as a bonus, I'm gonna give you a free video report on my predictions and my portfolio moves and why I'm liquidating 50% of my portfolio. Again, go to propertyllama.com/BiggerPockets to go get your portfolio analyzed. So let's jump into a scenario. Now, I am logged into my Property Llama account and I have a fourplex zone loaded up here. Now, this is a fourplex in northern Denver. So I recently had a commercial broker come do a full write-up on valuation of there, and he estimated we could sell for about $1.16 million. And it's currently about a 4.5% cap rate. Now, I'm not gonna go through all the details on the numbers on here, but I'm gonna focus on one spot. And I like to focus on return on equity on how to measure how my property is currently performing. This is not the buy side indicator, but the portfolio optimization indicator. So making about just under 11% return on equity. And what that is doing, in a simplistic way, it's taking the four ways we make money in real estate: appreciation, debt pay down, cash flow, and depreciation tax benefits, and says, hey, next year, I'm gonna make about $60,000, divided by about $560,000 in equity. That gives me about a 10.7% return on equity. Where else can you achieve a historically 10% per year return? The stock market. Well, if I can achieve about 10% in the stock market, have it be completely liquid and no headaches and hassle to me, I'm gonna go invest in there. Now, if my equity in my property is getting close to return on the stock market, that means I need to go out there and change my equity position. So I got the indicator, it's time to go out there and reposition my equity. What do I do? Well, in the old way, we'd come out here and we would do a 1031 exchange. So let's look at how a 1031 exchange performs in today's market. So I'm going to do a quick comparison of buying a property 8%, and I'm seeing deals about 6% cap rates and a 35% down payment. So I'm gonna run this 1031 scenario to model if I were to sell this fourplex and then take all the proceeds and use on a down payment on a new property. Now I'm gonna focus on return on equity here. The right-hand side is my current fourplex. The new property is on the left. Now look at return on equity. it actually goes down slightly. To me, that's essentially a rounding error. But my return on equity is a lateral move, or in this case, a mediocre trade. Now, when that happens, look what else happens. My cash flow is actually going down because I'm giving up my 4% debt for 8% debt and a higher down payment. So the numbers don't make sense. Why would I make this move? And so a great rule of thumb is that when interest rates are higher than cap rates, it's really hard to do these moves. Case in point. So here's what a lot of investors do. They see the scenario and they're like, oh, wow, this doesn't make sense. They hit a brick wall. And so then they either do nothing or they 1031 into a mediocre deal. Neither one is a great way for you to go out there and optimize your portfolio. All right, now I want to talk about the first concept I've learned from my real estate mentors that has me selling properties and not doing 1031 exchanges. And that concept is, what's your velocity of money? How fast is your money growing and how hard is your money working for you? So it's much easier to go through an example to really understand the power of velocity of money. So I'm in a side-by-side comparison feature in Property Llama. And on the left, I have a condo rental I bought in 2011. Then a number of years later, it was time for me to trade up. Why? My return on equity is about 7.5%. So I was below the historical stock market return. Boom, time to go out there and trade up. So what did I do? I sold it. I did a 1031 exchange into the fourplex that we're looking at today. Now, when I bought this fourplex a couple years ago, my return on equity went from 7.5% to 28%. That's a 4x increase on my return on equity. Plus, my cash flow increased from about $2,500 a year to about $15,000 a year. So think about that. That is the power of velocity of money. Sold a rental, took it and bought a better rental, more growth and more cash flow. Now on this comparison tree, I've added the fourplex in today's number. Compare the return on equity from when I bought the fourplex to today. 28% to about 11%. What's that show? My velocity of money has slowed down, and now it's time to go out there and make my equity work harder and faster for me. All right, so let's jump into the second key wealth building concept I've learned, and that is don't get fixated on taxes. So until recently, my number one filter for making investment decisions was don't pay taxes. I was in the mindset of the swap until you drop. And that's a very common way to grow and also minimize your taxes. That's great when 1031s are the best option out there, but what happens when they're not? So a couple of years ago, I sat down with a mentor and he put together a spreadsheet on showing when it makes sense to pay capital gains on property and not do a 1031 exchange. And when he sat down and walked me through it, it shattered my beliefs. After that, I no longer had my number one rule is not paying taxes. So now I'm gonna walk you through that same math. Now I'm curious, how many of you have never actually calculated what your taxes would be on a property and how you could reinvest it? I was guilty of it. So let's walk through the math. Step one is figuring out how much cash you'll have to invest and what your potential tax liability is. So if I sell my fourplex for about 1.1 million in change, subtract the closing cost and subtract the $600,000 loan payoff, I have about $500,000 in proceeds. Now that's the cash I get from selling the property, which is often different from your tax liability. Now to figure out your potential tax liability, there's an important number you need to have, and that's called your basis. Now I won't go into details on here, but understand this is how they help calculate what you owe in taxes. So I talked to my CPA and he said my basis is about $495,000. And then he calculated how much I would owe in taxes on there and came up with a blended 22% tax rate. So if I sell the property, subtract my basis and closing costs, I'll owe about $130,000 in taxes. So the spreadsheet highlighted a really important tipping point. You see, as the velocity of money gets higher and faster, the amount of taxes you're paying becomes a lot less important. Now we'll go through three options that are working in this high interest rate market. But before we do, it's really important to make sure that your investment is aligning with your goal. Now, for me personally, I'm looking to maximize my return, minimize my taxes, but I'm still in growth mode. Growth and a higher return equity is more important than cash flow for me. Now, also, I want to be hands-off as much as possible with my investments. I'm looking for my money to work hard for me not for me to go put sweat equity into the properties. So option one, I'm seeing some investors just sell and cash out. Now understand, these investors, they have different goals than I am. They're not in growth mode. They're often in retirement mode or exit mode. Now, a lot of times these are investors who have grinded for 20, 30, 40 years out there hustling, getting deals. And now they just want to enjoy life and simplify it. So they're selling and taking some chips off the table. Now, I've been investing for a fraction of the length of time for many of these investors, and they're often looking at multiple six figures in capital gains bill. Guess what? They're usually a lot less concerned about it because, like, you know what? I've got a few years left. I want to simplify and I want to enjoy life. So they're a lot less concerned about that tax liability than you and I are. So option two is selling the rental property, not doing a 1031 exchange, and then being patient and opportunistic in buying the best rental for you as the investor. What I'm seeing in the market right now is people are selling a property from the macro. They know they're getting some huge wins and taking equity off the table. And then rather being constrained by the 1031 timelines and potentially 1031 to a mediocre deal, they're patient and then go out there and buy the right rental property for them. So I see a lot of investors doing this and then buying a very high quality asset, a very high quality rental. So think a class A property. It may not be the highest growth or highest cash flow, but it's often a very safe, sound, and great long-term investment. And then here's the twist. They then do a cost segregation study to pull forward a lot of that depreciation. So I'm sure you've seen the headlines about real estate millionaires and billionaires paying less taxes than their secretary does. How? Well, it's by maximizing depreciation. So even though these investors have 6, 7, 8 figures in income and gains, they're able to maximize depreciation and often offset that income. Now, look, this is a really complex topic, and I've done numerous videos on BiggerPockets that do a deep dive. I highly recommend you go check out this 273 unit apartment building that breaks down all this into step-by-step mechanics. All right, so we're back in the property Llama comparison screen to compare option two. Now understand, we are buying a rental property and doing a cost segregation study. The assumption is we do it in the same calendar year so we can help offset the capital gains from the property I'm selling. So in this model, it can almost be a 50% savings in tax liability. So rather than only like $130,000, it might be more like $65,000. Guess what? That means I get to keep more money and either enjoy it or go invest more money in the property. Now, in this case, we're seeing a slightly higher return on equity. I'm able to invest more money because I'm saving taxes from the cost segregation study. However, while this option is great for a lot of investors, it's not the right option for me because I'm in growth mode. So let's talk about option three. In this new high interest rate market, there are now some great opportunities for high velocity money and high depreciation. So what's one of the biggest factors in having a high velocity money? Well, it's that old adage, buy low and sell high. Think about the opportunities after the 2008 crash. So many great opportunities to buy low and now sell high. Well, we're seeing those same opportunities in the commercial markets now. And specifically, there's some great opportunities in commercial multifamily or the big apartment buildings. We're seeing a lot of those buildings now sell at 2017, 2018, 2019 prices. So in addition to buying great assets on sale, we're also able to go out there and get high depreciation. The same concept where we did a cost segregation on that rental property, it applies to these apartment buildings as well. So they buy the apartment building and then do a cost segregation study, which gives us high depreciation. So a common question we get from investors is, why can't I do a 1031 exchange into these apartment funds? Well, because they're structured as syndications or funds, it's a completely different legal structure than going out there and buying the property on yourself. At 1031 exchanges, buy a like-kind property. Well, syndications and funds are not like-kind property to the rental that I'm selling and that you may be selling. So therefore, you can't do a 1031 exchange. So since these syndications and funds are structured differently, that means we can structure the returns differently as well. So let me walk you through a real life example that can show you some of this crazy high depreciation. So this was a syndication that I invested in last year. Now, normally for a lot of these multifamily value-add syndications, if you invest $100,000, a lot of times you'll get $50,000 to $60,000 back in depreciation in year one. Now, what they did here is they structured this differently where they actually could give more depreciation to certain investors. So I got 200% depreciation. So if I invested $100,000, I didn't get $60,000 back. It was 60,000 times 2. So $120,000 in depreciation. Now let this sink in. This really highlights how these real estate mega millionaires and billionaires are often to pay almost nothing in taxes. They get involved in these investments with high depreciation. So I invest $100,000 into here, I get $120,000 in year one in depreciation. Now, the way these are structured, these are just opportunities you can't get through traditional real estate investing. Now, understand, it's still investing. It's just a different game, a different way to put the deals together with its own different set of risks. All right, so let's jump back into the Property Llama comparison screen here. So let's compare the return on equity. So you can see the new investment should about double my return on equity, meaning I have a higher velocity of growth. Now, since this has a higher depreciation, it means I'll save more money in taxes or pay Uncle Sam less, giving me more money to invest. So the more I save today, the more I can invest in the future. Now, I model this not to that crazy extreme I did last year of 200% depreciation bonus, but more to 150%. All right, so YouTube audience, if you are in this situation, what would you do? Would you keep the fourplex at about a 10% return on equity? Would you sell and cash out? Would you sell, pay capital gains, buy a new rental for a slightly higher return, but a better asset? Or would you sell it and invest in a passive investment to maximize return and maximize depreciation? Let me know in the comments below. All right, so I want to take a step back away from these specific numbers and really focus on the concepts here, because the impact they can have on your long-term wealth is breathtaking, like 7 or 8 figures type breathtaking. So if I do nothing and just keep the property, so I'm not maximizing my return, but I am minimizing taxes paid, I'll be worth about $1.4 million in that property between equity and cash flow. Now, on the other end of the spectrum, if I go out there and maximize growth and minimize taxes, like in that passive investing example, I'll be worth about $2.4 million in those investments. That's over $1 million more. So the goal of this video was to help give you a paradigm shift like I had. So hopefully it's encouraged you to focus on your velocity of money and not just get tunnel vision on tax savings. So end on these questions. What's the best use of your capital? What moves can you make in your portfolio in this new high interest rate environment? Let me know in the comments below.